Perfect. So I will get started here. Let me just turn this off. Um, Again, thanks for joining me today. Really excited to chat. As a lot of you on this call already are clients of mine, and we've been having our reviews as we wrap up 2023. Been having really good conversations with you guys about goals for 2024, questions you have regarding investment, cash flow, your job market, economy. So I really want to spend today to dive in and talk about more of my thoughts regarding what's going on in the world, and hopefully open up to questions at the end. Would love to have an open dialogue. If any of you do have questions that are more pertinent to you specifically and want to chat, I'm all ears. Happy to spend time after this call in the coming weeks. Happy to set up a Zoom or a phone call to discuss your what's going on in your world specifically. So again, trying to keep this about 30 minutes. If I run over, apologies. I'm passionate about this stuff, so I end up just rambling on. But we'll try to get you out of here. So looking kind of ahead, right? So as we head into 2024, we want to look back the last few years. When we look at the economy and specifically the stock market, markets have really enjoyed good performance over the last few years. We have record job growth. We have consumers with excess savings, and we had a huge economic stimulus, right? So in the last one being record low interest rates. We had, coming out of COVID, jobs growth was huge. People just had savings, right? I'll talk about it here in a later slide about what we call like revenge travel post-COVID. But the average consumer had an incredible amount of money in their pocket to spend on luxury goods or whatever it may be. With that said, again, we look into 2024, we need to be mindful of, we don't know what's going to happen. We can't rely on smooth sailing as we've seen in the past. Clients of mine know we can't use past performance to predict future outcomes. We need to be smart and have a plan for what's ahead for us. Talking about quickly to start, talk about the economy. So we do feel as financial advisors that it does seem to be that there's going to be some storm clouds coming in our direction. And I want to be able to talk about what that looks like on the horizon. So why do we think things are getting kind of dark or getting grimmer, right? First off, economic stimulus is fading. Coming out of 2020 lockdown, like I said, U.S. consumers, we're flush with cash, right? We had nowhere to go. We had nowhere to spend money, so we just had money. The U.S. consumers combined for over $2.1 trillion in excess savings. Interest rates were at record lows, and again, the U.S. government was stimulating the economy. This allowed for business to rapidly grow. You could go spend things, right? Car mortgages prices were low. We're at historically low mortgage rates. Car loans were cheap. You can go buy a car, right? Now in 2023. And I talk to a lot of clients of mine, they feel this. Many of us, our excess level savings have been drastically depleted, if not almost depleted. This is due to us, again, spending a huge amounts of money on travel and large expenses since the pandemic. With interest rates rising, making these larger expenses, such as buying homes, cars, it's just not as affordable. Mortgage rates as of today are at record highs over the last 10 years. We're pushing 8%, right? Gas prices are through the roof. Car loan prices are through the roof. Because of this, the average U.S. consumer is now paying well over 78% higher in fixed monthly obligations. This is a huge increase in monthly costs, and this is going to have a huge effect in 2024. Looking at a few things, kind of headwinds in the economy, when we combine all of this, our expectation is that we're going to likely see a slowdown in unemployment market and seeing banks tightening lending. This is a recipe for the economy as we kind of edge into 2024 to see what we call a mild recession. So the term recession we throw around, economists throw it around, we throw it around, advisors everywhere talk about it. It's hard to predict the future. Like I said, we have no real understanding of what's going to happen, but given kind of market performances, market indices, we do feel there's going to be a slight pullback and there will be a recession, but we feel strongly that it's going to be a milder recession. While we see this happen in the new year, again, it isn't a surprise. It does make sense given where we've been the past few years. There was huge job growth in hiring in 2020 and 2023. We're now going into 2024. I don't love talking about like post-COVID world, but it is real, right? Coming out of COVID, there was huge job growth. I live in San Francisco. A lot of my clients and a lot of you on this call today live in California, the Bay Area. There was a lot of stimulus in the job market. Companies were hiring, a lot of stuff going in that direction. As the economy starts taking a turn, companies are hiring less and less people going into the new year. On the graph you see on the left side of your screen that shows job growth starting to set negative, that headline scares a lot of people saying, oh, there's going to be huge layoffs, there's going to be an issue. What we're predicting is instead of just huge ramp ups in hiring, we're not seeing layoffs, we're just seeing slow. We're seeing people just not hiring. Companies are just not needing to fill spots as they were in the past few years. Again, as we talk about banks tightening, banks getting more stringent on lending is justifiable and warranted. If you look under the hood, and what we talk about a lot is credit card delinquencies are at the highest level they have been in almost a decade. Savings, like I said, have been depleted. So using credit, we're starting to see the American consumer stretch very, very thin. We're using credit cards more. Again, as I have client conversations as we lead into the new year, everyone's talking about as we get ready for the holiday spending, just we start spending more money on travel, seeing family, whatnot. We don't have that safety net of cash like we used to. We're using credit cards to spend. And that is causing, again, leading into a potential recession. I already talked a little bit about this, but put some facts to it as I talked about this kind of past summer of revenge travel. We didn't travel during COVID. We sat in place. We didn't do anything. We built cash. We built reserves. Government was sending out money to stimulate consumers so they can go spend. We were hoarding cash like no other. Now, to see this further, we kind of talk about these real indicators. Us as consumers are starting to slow down our spending again in these credit card things. We're starting to not be able to spend as much. Chart on the left shows credit card spending in the last 12 months. excess credit card spending has flattened and even gone negative. We're out of money. We're losing. The average of us don't have all this. On the right side, here are some headlines suggesting the slowing is already upon us over the last few years. Disney, for example, is getting fewer visitors than they have been. Airline prices are down. Airfare prices are down. Luxury brands are reporting sales being down. Again, people just aren't spending like we were over the past 3 years. And this is going into why we think there's going to be a recession in 2024, again, being a mild one, if that. Interest rates are starting to creep up as they have been, less money in our pockets. And the big one that I've seen since now we're November is student loan repayments starting again as of October 1st. I've had a lot of conversations with clients about their student loans. We've been fortunate, so to speak, in the last 3-4 years where interest rates have been flattened. They haven't charged us, so we've been able to not necessarily have to pay more student loans. Now, a lot of my clients, I'm seeing younger clients specifically, are starting to see monthly expenses of $300 to a couple $1,000s a month of paying out these student loans. So that's something we haven't had in the past 3-4 years that we needed to now account for. So again, talking about why we expect the recession to be mild. I want to give kind of 5 reasons why economists that we work with think it's going to be mild. I'll read through a few of them. One, we have a healthy consumer. Again, while we're feeling like we're not flush with cash, overall consumers are what we call not over levered like we have been in the past. 2008 recession, I'm sure you've seen movies like The Big Short or other ones like that. We were hugely levered. People were taking out huge loans on homes that they couldn't afford. They were giving out loans to people that are subprime lenders, right? We were giving loans to people that could not afford a house because we were trying to stimulate the economy, led to a housing bubble. So this time around, we don't nearly have the same leverage that individuals did back in 2008. While number 2, it kind of feels hard to find a job. I can't tell you how many clients I've worked with that are looking for a new job. They're like, it's tough out here. And it's not that people are getting let go a lot. It's just they're transitioning careers laterally or upwards, and there's not a lot out there. We don't think they're going to have large layoffs, but it's just going to be harder and harder to find talent as we go forward. The other one I already talked about, we don't have there's few excesses in the economy. We don't have a housing bubble. There isn't. You look at car lots on the street, there aren't thousands and thousands of used cars just sitting there. There's not a huge inventory. So there's not a huge issue with supply chain and demand there. And number 4, why we think it's going to be mild, is there still is solid government spending in the U.S. to prop up the economy. We started in 2020, and what Biden did, right? We have the Inflation Reduction Act as well as the CHIPS Act. So we're doing, from a government spending perspective, we're doing things to, while we lead into a recession, we are curbing kind of the real effects of what that may look like. Talking through this next slide. So switching gears from just macro spending, understanding the economy from a consumer perspective, talking about interest rates and inflation. So talking about the two of those, the Fed raises interest rates, right? A lot of us know the Fed raised interest rates to slow down the economy and curb inflation. In higher rate environments, everything tend to go up, meaning credit card rates go up, home mortgages go up, car loans go up, et cetera, right? It costs more to lend from a bank. All that is kind of factored into when the Fed raises interest rates. We've already discussed that the average consumer has spent through a lot of their savings and unfortunately having to use credit cards to keep afloat. Where we are today is kind of astonishing. We are now close to $1.3 trillion in US credit card debt. We haven't seen this level of consumer debt in many years, right? This is not normal for the US economy to have this much levered on credit card debt. The middle slide you see in front of you shows housing and auto affordability. Again, mortgage rates, the 30-year fixed rate mortgage is hitting highs of 8%. A lot of you on this call I know bought houses in 2020 at mortgage rates of 2.5%, 3%. I remember having conversations with you and you being like, hey, 3% seems high. We're nervous. Should we do it? Well, now looking back, right, hindsight, looking at that, 3% is a hell of a lot better than what people are seeing now at 8%, right? Car loans are through the roof, especially those that are needing cars to get to work. Now, a lot of us are out of kind of work from home. We're starting to go back to the office in the Bay Area. People are needing to get back to car loans. Car loans can be seen between 14, 15%. It's an expensive world we're in. And we expect the Fed to possibly raise interest rates one more time this year before they start cutting them in mid-2024. So all in all, we expect higher interest rates going the remainder of 2023 and into 2024, hoping that they start cutting them down going into mid to the end of next year. So talking then about the market, right? So we talked a little bit about the economy, we talked about interest rates, inflation, US consumers, GDP, all that. Market positioning as we've been. So tying this into that, as a financial advisor, a lot of you know, my job is to ensure you as clients are positioned properly within your investments and savings. No one has a perfect measure of how the market's going to perform in a given year, right? We look at the last 10 years, it's up in the air of how it's going to perform. We can make predictions, right? But a lot of times we could be wrong. Headlines on the left of your screen show kind of what the expectations of what we were thought things were going to look like going into early 2023. A lot of these headlines were wrong, right? We were Forbes posted January 9th, 2023, S&P could fall 24% this year. These stats are as of May, but we're even higher. Market's up about 11, 12% this year. The big one too, looking at tech stocks. People were worried, Yahoo was saying, we're worried tech's not going to perform in 2023. Tech year to date is up close to 45%, right? We can't predict how this is going to go. Energy stocks keep them, don't expect them to outperform anything. Energy's outperforming the S&P this year, right? I show you this because how we look at stock market investing, we want to be well positioned. We'll talk about asset allocation, but it really ties to just being in the market for as long as we can and not trying to time it, because there's going to be no specific industry that we can say, hey, going into next year, real estate's going to kill it. I want to put all my money in real estate because I can guarantee it's going to do well. It's impossible to predict that. Looking at kind of the market this year as a whole in this graph, choppiness is expected. The market doesn't work as a linear up. This is why being invested smart and with proper financial planning is so important. Again, volatility is part of the game. It's normal to market cycles. Historically, the S&P 500 experiences 3 to 4 pullbacks a year at 5% or more. Meaning, as you look in this graph, you see market goes up, comes back crashing down, goes a little bit up, down, up. But overall, if you look at the trend, it trends higher, even with 3 to 4 larger pullbacks. The market doesn't move in this straight line, so we're going to have to expect and prepare for choppy waters. I have conversations with clients throughout the year, right, where they're saying, hey, Dash, Q3, Q4 sucked. Markets look down. What are we doing? How should we position our portfolio? Well, let's look at the whole plan, right? Looking at this kind of sidebar situation, if I have a client looking to pay for their kid's college in 18 years and their kid's 2 years old or 1-year-old newborn, we're not going to necessarily abandon the ship and say, hey, markets kind of sucked in international and tech in the last 6 months. we got to put you in something else for the next 18 years, right? That'd be silly. We're looking at a macro scale of we're investing for the long run. We don't want to make minor tweaks and be fearful or act on irrational reasons to then predict what's going to happen in the long run. So talking about, well, why do we remain optimistic for the long run, right? So despite knowing, like I said, we're predicting a mild recession in Q1 of 2024, we remain optimistic for the long run. I had a conversation with a client today. I was letting them know, it's like, hey, it's going to be scary. It feels scary. No one likes losing money, right? Q4 of this market, most indices were down. I don't like losing money. Clients don't like losing money. There's a behavioral psychologist that says people hate losing money 2 times more than they like making money. That's just a fact, right? For me and my job, when the market's performing well, people are making money, my phone doesn't have to be ringing, right? People are like, Dash is doing this job. It's great. When things start going down, it's when we start being fearful, start panic. So a few things why we're staying optimistic going into the new year. 2 reasons. Fed rate hikes should be ending soon, right? So that causes interest rates to fall, hopefully moderating inflation. Things start coming back to a level we're more comfortable with. Markets typically rally following recession. You can see that represented on the graph on the right. Steering, that's market volatility, average S&P return. We hit that line, that end of recession, historically speaking, we usually push forward. So that's kind of a light at the end of the tunnel as we approach a recession. That's why we stay invested, saying we're not going to abandon the ship, saying we're hitting a recession, we need to sell everything. We feel comfortable staying in the market long term. Last one is due to high yield, a lot of our clients are in money market funds. We're in high yield savings. I've preached this the past year or two. I'm not that I'm getting sponsored or anyone by them, but like Capital One, Discover, Ally, they're paying 4 or 5% just to have your cash in their high yield savings. That in times of choppiness, that seems like a safe haven for investment. But right now, we're as the US, we're at a record high of $5 trillion in what we call money market funds, cash-like securities. I feel that once we start seeing positive waves in the market and interest rates dropping, things start going in our direction, money's going to start flowing back into long-term equities. People feel fearful right now, but once they see, hey, things are starting to clear up, sky's starting to show some sun, money's flying right back into the US economy. We're going to start spending on cars again. We're going to hopefully start buying those houses that we've been holding off on, right? Things are starting to clear up, and we're feeling good about that. Just kind of wrapping it up for you guys. I guess I can turn this off, right? How do I stop sharing? Just show my face. Kind of wrapping it up in summary, again, looking at the economy, looking at the markets, inflation, interest rates, what has happened in the past year and kind of what we've expected going forward. As investors, the big questions I get all the time is, okay, Dash, that makes sense. Choppiness, things look good, but now they might not look so good. What do we do, right? Where should we be putting our money? Is it best to own stocks? Is it bonds? Is it real estate? Should we keep it in cash, right? All valid, all great questions. And a lot of you on this call know, and have worked with me for a while, and I preached, it all comes down to your specific circumstances and goals. Everyone's financial plan looks different. I have no control, and you have no control over how the market or economy is going to shape out in the next 1, 2, 5, 20, 30 years, right? So what we can control is how we behave during these times of uncertainty. How do we handle the turbulence? It's easy, like I said, to stay on track. It's easy to have a financial plan when we're making money, things are working out, jobs looking good, life is sexy and fun. We don't worry about it. When things get rocky is when we need to turn back, look at the plan, have a conversation with me, right? And say, let's look at from a full view. Let's talk about it. We're coming off those record spending years. We as consumers are feeling the weight of everything being more expensive. I can't tell you how many conversations I've had with clients recently where they're like, we're going into the holidays and we feel like we're not going to spend nearly as much as we have in the past on gifts and travel. We're staying home this year. It's tough. The other big one too, again, student loans. With them starting up again, we have less money in our pockets. We're paying the government. But figuring out a plan with our student loans, if it's consolidating or if we get public loan forgiveness, again, conversations we can have. And the big one too, 2024 is a presidential election year. So we're heading into that market cycle where we're going to have a new president coming on next year. Market's going to be rocky. As I always tell people, the stock market hates uncertainty. So as we head into an election year, we're going to see volatility. We're going to see turbulence. We're hopeful that if there, like I said, there is a recession, that's going to be a mild one. But again, it's important for us to be prepared for all outcomes, whatever they may come. Um, I'm here again, as I talked about. We're not as financial advisors. We're not in the game of making huge predictions in the world, like the world economy. If I knew something that you guys didn't, I promise you, I'd be a trillionaire sitting somewhere drinking daiquiris, not talking about economics on a Thursday at 4. But I don't know. None of us know. So it's important that we stay on track, keep a plan in place. So with that, I finished hopefully a little early so I can get you guys back to your day. Please let me know if you have any questions. I'm happy to stay here, answer some questions through the Q&A. So if you have any questions, let me know. If you have anything specific to you in your financial situation, like I said, as we wrap up the year, I'm happy to have conversations. Now we're into the new year. For those of you on this call that aren't clients of mine yet, if it makes sense and you want to have a conversation, more than happy to do so. I think it's important to take a step back, look at your whole picture, look at cash, savings, income, expenses, debt you're utilizing, house payments, all of that, as well as your stock portfolio, and have a plan as we go into the new year. And this is the best time to do it, is that end of year. So that's all I got. If any of you have any questions, feel free to let me know. More than happy to discuss it. Looks like we did have one question. Do you think the conflict in the Middle East will have any impact on the economy going into the next year? Great question. Short answer is yes. Long answer is, how does it affect? It's unsure. What's going on in the Middle East has affected the European markets and Asian markets substantially. So what we track is the EFO, which is the index for tracking the not US market. That has been lagging substantially over in the fourth quarter, one of our worst performing sectors. And that is because of what's going on in the Middle East. Again, like I said, uncertainty creates choppiness in stock portfolios. So what's going on in the Middle East has caused that. What's also led to this, again, is uncertainty with presidency. Right now, as you know, we're in a huge deficit. And recently, Biden has given aid to Israel to help, given the situation. Again, doesn't matter what side of the coin you're on this regarding the Middle Eastern conflict. U.S. is stimulating Israel in this. We sent trillions of dollars from our already huge deficit to aid Israel. A lot of politicians are saying Biden's on his way out as president, and he's adding more to the deficit, makes some people nervous, some people excited. It's creating turbulence in it. So I think there will be some rockiness as we head into the new year. But I think as we look to, as I tie that into president in the election, we have countless studies, and I'm happy to spend another time talking about it. But usually when we look at presidencies and who's going to win or who's going to lose, if it's red or blue, doesn't matter. There's always rockiness. It doesn't matter if Trump's president or Biden's president or Obama or Bush, it doesn't matter. The market's going to perform rocky in that year until we elect. But if you look at the S&P returns over the last 5, 10, 20 years, we're net positive substantially. The market doesn't care who the president is. It's people. What the economy cares about is earnings. It cares about forward projections. It cares about the average consumer. People are going to buy iPhones from Apple if Trump's president or Biden's president, right? People are going to keep buying cars. They're going to buy houses. They're going to invest in infrastructure. They're going to invest in California's roads and government, regardless if it's Gavin Newsom or someone else. So I feel confident going into the new year. It's going to continue to go up in the right trajectory. We're going to see some pullback, right? That's expected. But I think from a financial advising perspective, we are staying invested in the Middle East and international equities. While we put a lot of our kind of our modern portfolio theory, we think U.S. economy, for the most part, we put a lot of our assets into it because that kind of runs the world economy, so to speak. But we'd be silly not to put some money into international equities, whether it be first, second, or third world countries, as well as putting stuff into U.S. infrastructure. So that was a long-winded answer, but hopefully that answered that for you. Any other questions before I let you guys get out of here? Perfect. Well, hey, I appreciate everyone taking time out of their busy time of year to come sit with me. If you have any questions, let me know. I'm happy to talk offline. Feel free to email or call. Have a great holiday season. If I don't talk to any of you before now, have a great new year, and looking forward to talking to all of you in the new year. Have a great day. Take care.